We're a commodity-rich country in a commodity-short world, and of course the commodity markets were booming. We were finding investor interest in Canada in a wide range of things, whether it was in the retail space because the U.S. market was very soft, or in a variety of other areas. At the same time, you went south of the border, the U.S. was wrestling with a deficit that was almost $1 trillion. You had a situation where employment still hadn't regained what the level of employment it had before the financial crisis. You had a variety of things in the housing market that were still very, very soft in terms of indebtedness and valuation on houses and the like. Over in Europe, 2 years ago, the story was that Europe was on the cusp of recovery. They'd gone through the largest setback since the inception of the Eurozone, and Europe finally looked like it was getting into growth mode. In fact, even a year ago, many analysts were saying Europe's finally getting its act together. This is going to be the year where things materially improve. And if you, of course, you go around the world to Asia, we tend to talk about China more than anything else, where growth was still reasonably buoyant. They had some issues with respect to imbalances, but by and large, powering along, very important for the commodity market. The BRICS were still doing reasonably well. And so it was much more of an emerging market growth story. The US was disappointing. Europe was finally getting its act together, and Canada stood out because we had recovered more quickly in the financial crisis. Things were better here. Our housing market, to some people, was defying gravity, but by and large, things were very, very solid. Now you step into where we are right now, and in many cases, the things that made Canada special are still in place. For example, we are at record levels of employment. But the U.S. employment growth is now twice what it is in Canada. Employment growth is moderating here. Employment growth is stronger. The U.S. is playing catch-up in a way that some analysts hadn't anticipated would catch with the degree of traction that it has had. The Canadian housing market, well, by and large, has still been very strong. You look at the December numbers on a year-over-year basis of resales and the like, and they remain reasonably buoyant. Some markets are showing signs of cracking, but at the end of the day, that story was still in place. In the U.S., well, you had about 15% of Americans that owned a home that had a mortgage bigger than the value of their home, but 2 years ago that was 30%. Okay, so that has come down dramatically. Directionally, the U.S. is beginning to shine. If you look at the government deficits, well, we're still poised to balance the budget at the federal level, or that's the story today, maybe with a little bit of expenditure cuts along the way. In the U.S., 2 years ago, $1 trillion deficits. Now we're talking about a deficit below $500 billion. Okay, there has been a huge move down. The consumer is in gear. Debt has been paid down. Housing prices have improved. Consumer balance sheets are stronger, and the consumer has a lot of pent-up demand. Average age of a car in the U.S. is 11 years, 4 months. So the U.S. is in a classic cyclical recovery. With the amount of pent-up demand that is there right now, I suspect that we're going to see decent growth in the U.S. over the next couple of years, barring another major accident. Be obviously setbacks in the shale area in the energy business. But there's going to be offsets with respect to lower energy prices, which many people look as technically a tax cut in terms of providing more spending. So we can see U.S. growth sustaining around 3% or so at a time when Canadian growth will be closer to 2%. And if oil prices go down lower and they stay down longer, getting to 2% growth may be tough on this side of the border. In Europe, well, in Europe, we're still waiting for the recovery to take hold. In fact, we're talking about another emergency stimulation from the central bank there, new quantitative easing. Italy is borderline recession. France isn't doing all that well. Structural unemployment remains very high. Youth unemployment rate in Italy is over 40%. Deficits have come down, but any accountant will tell you if you got a deficit, your debt levels are going up. But population isn't really, because population is growing very marginally. In some countries like Germany is going down. And people have changed their view of Europe from one of a potential opportunity emerging to one where structural problems are there and they're not going to go away anytime soon. throw in what's happened in Ukraine, what's happening in the Middle East with Islamic fundamentalism, and the slowdown in Asia, and the uneven performance of BRIC, Brazil, it is growing at a very low rate, borderline recession. Russia, we don't know how big the recession really is. India is accelerating out of a balance of payments crisis, but remains fragile. China, well, it's decelerating. It's going to have a terrible year. It's going to only have 7% growth. Think about that. You know, we're trying to get 1% growth out of Europe. 7% growth in China is still very positive fundamentally. But the world has changed, and from an investor point of view, it has changed in a way that makes the U.S. a very attractive investment opportunity. People will tend to want to hold on to their money in times of crisis rather than worrying about the rate of return. And when you see what's going on in Europe and the political, geopolitical problems that exist, investing in the U.S. Treasury bill and bond market seems to be a good place to be. If you're looking at the fact that the U.S. is back in the game and is likely to lead the G7 in performance, UK is going to do it not too badly. But you're seeing money flow in for opportunity as well. If you're investing in retail, which side of the border do you want to be on right now? Canada or the U.S.? The consumer is coming alive. Businesses are investing more. The government deficit is coming down. All of these things have changed investor attitudes, and that tends to cement in something that we have seen very pervasively, and that is the U.S. dollar is strong and U.S. interest rates have come down. Are those factors, any of those factors, going to change materially? In other words, the U.S. stumbles, and as a result, growth falls below Canada. Is Canada going to accelerate? Is Europe all of a sudden going to turn around? Is the emerging world going to get into a gear, at a much higher gear than we currently anticipated? The odds of that happening in the next 18 months are relatively low. So we have a landscape globally that tends to favor investment in the U.S. in a way that we haven't seen in a fairly long time. Let's take a closer look at the two areas that impact us the most, and that is Asia and the U.S. In Asia, I said China's slowing down. It's having a bad year, 7% growth. That economy has grown at an average rate of almost 10% for a quarter of a century. As the population enters the market economy, as urbanization accelerates, we're going to see slower growth. Within the next 5 years, 6% will be normal, perhaps lower. It is a structural slowdown. On top of that, you have a cyclical element. The government is trying to slow down a number of things. Overnight, of course, they clamped down on margin accounts, and the Shanghai market had a very bad night last night because of that. So we've got those cyclical elements, but the economy will slow down. But that is not going to change the reality that China or Asia will dominate the commodity markets. You know, if nickel, copper, zinc, iron ore, coal go across a border to another market, there's a 50% probability it's going to China alone. If you look at the U.S., 10% of global steel capacity, China, 50% of global steel capacity. China, the largest car market in the world. Chinese tourists outspent Americans globally by $40 billion last year. So we're seeing a slowdown, but the reality is longer term, the growth in the so-called emerging market space, at least in some countries, is going to be sufficient to mean that it will increasingly dominate global growth. Developed world accounted for 2/3 of global growth back in 1990. Now we find the so-called emerging market space, even with the U.S. accelerating, China slowing down, is still the major driver of growth. Because it has slowed down, the commodity space has weakened. Because iron ore and copper supply is going up, metals have weakened, and in general, that nervousness has changed the investor configuration. Talking about the U.S. being back in the game, and I mentioned the consumer, the fact that employment is growing faster, but income is growing faster too. The U.S. has a real problem with income disparities, and that, in my view, is going to continue and probably widen over time. But you're going to find, in general, Americans are going to be spending more with the pent-up demand that they have. Because the pent-up demand, for example, in autos, with an average age of a car, 11 years, 4 months, you would need 2 to 3 years of good sales in order to bring that below 10 years, or down to under 9 years where it was before the financial crisis existed. And as a result, business investment is tending to focus in on that Investors are spending more plant and equipment expansion, and you're going to find that has more duration as well. On top of that, the export sector in the U.S. is dramatically different than it is in Canada. 3/4 of our exports go to the U.S., and that's good news nowadays. 50% basically of U.S. exports go to the emerging world. And those markets, even though it's very uneven globally, those markets are growing faster than the U.S. domestic market. Think of Boeing, for example. Years of back orders of sales as infrastructure is built out in many economies. So the U.S. private sector is now firing on all cylinders for the first time in a long time. Of course, the government is different too. How did the government get from a peak deficit of $1.4 trillion to under $500 billion, which is basically the forecast of most people on a go-forward basis? I don't think it's going to improve substantially below 400, but at the end of the day, we have gotten down dramatically. Well, people are working more, they're paying more taxes. The equity market's relatively buoyant. Housing market has tended to improve. But spending has been cut as well because 3 years ago, the Democrats and the Republicans agreed that if they couldn't agree, that they would put in something that was called the fiscal cliff. Cutting back spending, taking away temporary tax cuts, that created a fiscal drag on the U.S. economy about 1.5 to 2 percentage points. Now that the deficit is below $500 billion or around $500 billion, the mood in Congress has changed. Congress has never been one to overachieve when it comes to deficit reduction. I can't remember a period in history where they really have really wanted to overachieve in that particular area. $500 billion is the deficit that existed before the financial crisis. So we are going from a government dragging back on the economy, tax increases, spending cuts, to a government that's going to be neutral or positive on growth. State and local governments are in better shape as well. So you've got the private sector and the public sector actually rowing in the same direction now. And that explains, in a way, why the U.S. is looking better and why forecasts have changed so significantly. Now, 3% to 3.25% growth, quite honestly, in the U.S. context historically, is not great. But that's the new normal. In fact, the Federal Reserve is suggesting that the underlying rate of growth in the U.S. economy is something like 2 to 2.25% on a long-term basis based on the demographics and a whole lot of other things that they look at. But certainly it is good enough to attract investor interest and to place the U.S. in the leadership position of the so-called G7. Not a hard race to win nowadays. Okay, so talking about that, there's one more area in the U.S. economy I want to talk about before I get into Canada, because this is very important for financial markets, and that is, how did the Federal Reserve stop buying $1 trillion annually, which is basically what they were doing during the quantitative easing phase? In other words, in 2013, the U.S. Federal Reserve bought $1 trillion of U.S. government bonds, mortgage-backed securities. How did they go from that to zero, which is what they are this year, without the bond market reacting negatively? Because Economics 301, my money and banking course, suggested that if you